Well, welcome everybody, and thank you for joining us for today's presentation. My name is Mark Feiner, and I am the chair of the tax group here at Merthyr Carolina. And today I am joined by my partner, Mark Tarallo, in our business and finance group. Today we're going to be talking to you about PPP, Paycheck Protection Program loan forgiveness, a detailed walkthrough of the forgiveness application, and a summary of recent guidance. First, I'm going to take a moment to go over a couple of housekeeping items. All callers are currently in listen-only mode. Unfortunately, due to the amount of material we have to cover, we may not have time to answer questions at the end of the presentation. Of course, contact information is included in the presentation, so feel free to contact us afterwards if legal counsel is needed. The webinar is being recorded, and all of today's participants will receive an email following today's presentation with the PowerPoint slides and a link to the webinar recording. The one caveat I have to make before we begin the presentation is we will probably all be back here next Thursday telling you that half of what we told you has been changed, because that seems to be the way the PPP guidance is going. As a matter of fact, additional PPP guidance was issued last night. So hopefully most of what we say is accurate today, but we will certainly keep you updated as things change. Next slide, please. So before we get to the actual application, we just wanted to go over a few things that recently occurred, particularly the Paycheck Protection Program Flexibility Act of 2020, which changed some of the provisions of the CARES Act and everybody's understanding of how the PPP program would work. Next slide, please. So this Paycheck Protection Program Flexibility Act was signed into law on June 5th, and it's effective immediately. But one thing to note is that some of the provisions of the Flexibility Act are effective prospectively only, while other provisions of the Flexibility Act are effective retroactive to the date of enactment of the CARES Act on March 27th. The Flexibility Act is intended to provide guidance to borrowers who have already received their PPP loans, as well as borrowers still contemplating a PPP loan. And according to a New York Times article that was written yesterday, about $130 billion in PPP funds are still available to be lent, but the SBA and the Treasury have made it clear that June 30th is the last date on which a PPP loan application can be approved. So there is a bit of time, but not much time before the program expires. The goals of the Flexibility Act include making it easier for certain expenses to be paid with PPP funds to qualify for forgiveness, and to give borrowers more time to use the proceeds towards expenses that qualify for forgiveness. And really the latter goal is to allow borrowers to maximize the loan forgiveness amount. Next slide, please. So the covered forgiveness period, which was originally 8 weeks from the date of the loan disbursement, was subsequently changed to line up with payroll periods. For PPP loans approved after the date of enactment of the Flexibility Act, the covered period is 24 weeks from the disbursement of the PPP loans, or December 31st, 2020, whichever is earlier. Again, that's only for loans that are dispersed after the enactment of the Flexibility Act. Some things to think about this 24-week period are that given that the PPP loans can only be approved through June 30th, in all likelihood, most if not all borrowers are going to fall under the 24-week covered period, absent some additional legislative action or SBA guidance that extends the June 30th deadline. The extension is particularly important to borrowers who are reaching the end of their 8-week covered forgiveness period and haven't been able to open their business yet or use all the PPP funds for qualifying expenses. But some other things to think about are that the longer covered forgiveness period is going to require a borrower to wait longer to apply for forgiveness, because as my partner Mark is going to point out later in the presentation, certain tests for the loan forgiveness, like the reduction in the forgiveness amount based on a reduction in wages or full-time employees, can only be applied after the covered forgiveness period ends. Also, a negative of the longer forgiveness period, covered period, is it's going to increase the burden to provide necessary documentation for loan forgiveness. And an example of that would be that the 24 covered forgiveness period is going to increase the federal and state payroll tax cost substantiation burden by requiring businesses to provide employment tax forms for multiple quarters rather than just the first quarter of 2020. So as I said, the 24-week period only applies to borrowers that receive funds after the enactment of the Flexibility Act. For borrowers who have already received a PPP loan, they can elect to continue to use the 8-week covered period. And one of the questions that we have been asked is whether a borrower can choose somewhere in between the 8-week period and the 24-week period. But the way that the Flexibility Act is written, it provides no flexibility. So borrowers don't have the ability to choose a covered forgiveness period right now in between the 8 or 24-week periods. And if a borrower wants to take advantage of the 8-week covered forgiveness period, they don't have to do anything. They can just hand in their forgiveness application following that 8-week period. And in deciding whether to retain the current 8-week forgiveness period or switch to the 24-week forgiveness period, borrowers need to consider the degree to which they've already maximized the loan forgiveness, whether they expect to at least maintain employee headcount and compensation, and the increased burden to compile the supporting documentation. Next slide, please. So previous guidance had indicated that no more than 25% of qualifying non-payroll costs were eligible for PPP loan forgiveness. And under the Flexibility Act, that ratio changed from 75% payroll, 25% non-payroll, up to 40% for qualifying non-payroll costs. While the types of non-qualifying payroll costs haven't changed, those are mortgage interest, rent payments, and utility costs, the language of the Flexibility Act created a cliff, whereby if a borrower spent less than 60% of the PPP loan amount on forgivable payroll costs during the 8-week or 24-week testing period, they wouldn't be entitled to any loan forgiveness. But guidance actually issued last night by the Treasury and SBA indicates that a borrower spends less than 60% of the PPP amount on payroll cost will receive some forgiveness, a proportional amount of forgiveness. So under the SBA and Treasury's liberalized rule, a borrower spends less than 60% of its loan amount on payroll costs will be able to have forgiveness on whatever payroll cost it pays, plus some otherwise non-payroll cost expenses. And an example that I can give you is if the loan's $100,000 and the borrower spends only $54,000 on payroll, if you were to divide the $54,000 by 60%, you would get a total forgivable amount of $90,000. And that would mean in the example that since $54,000 of the loan was spent on payroll, $36,000 of non-payroll costs could be forgiven. So out of a loan of $100,000, $90,000 of the loan could be forgiven. Next slide, please. So there are workforce and compensation reductions, safe harbors that have been greatly expanded under the Flexibility Act. Originally, borrowers could avoid a reduction in loan forgiveness based on workforce reductions or compensation reductions during the period, as you'll see here, February 15, 2020 to April 26, 2020, by restoring the compensation and workforce levels to what they were on February 15th. That had to be done by, or has to be done by June 30th, 2020. Under the Flexibility Act, that June 30th date has been replaced by a December 31st, 2020 date. So borrowers now have until December 31st, 2020 to restore previous headcount and compensation reductions to their February 15th, 2020 levels to avoid a reduction in the loan forgiveness amount. The Flexibility Act also provides two new exceptions that permit borrowers to obtain full forgiveness without fully restoring their workforce. One question that we had gotten previously was, well, what happens if I let somebody go and I want to rehire them and they refuse to come back for work, And in many cases, that was because they were making more on collecting unemployment than they were in salary. So the previous guidance exempted PPP borrowers from a reduction in loan forgiveness caused by a reduction in full-time employees if they could show that the employee turned down the offer to be rehired at the same salary and wages as they were making before the pandemic. So the Flexibility Act provides two new opportunities for borrowers to be eligible for full forgiveness. And those exceptions would be if the borrower is able to document that they're both unable to hire an individual who was an employee on February 15, 2020, and document an inability to hire similarly qualified employees for unfilled positions by December 31st, 2020. And that goes to, you shouldn't have to just rehire somebody to get a body in there to achieve full forgiveness. If you can't hire somebody because there's nobody with that skill set, you're not penalized for not hiring. The second exception would be if the borrower can document an inability to return to the same level of business activity as the business was operating at prior to February 15, 2020, due to compliance with federal requirements or guidance that was issued between March 1st and December 31st of this year, relating to standards of sanitation, social distancing, or other worker or customer safety requirements related to COVID-19. And one open question relates to, how and when the level of business activity for a given borrower should be measured or determined, because the Flexibility Act does not provide any guidance on that. So that's a question a lot of people are having, and we expect guidance to be issued on that shortly. Next slide, please. Other benefits of the Flexibility Act include an extension of the loan payment deferral. Originally, the PPP loan payments were subject to a 6-month deferral period. The Flexibility Act extends the loan deferral period to whenever the amount of the loan forgiveness is remitted to the lender, or 10 months after the applicable covered forgiveness period ends, if the borrower does not apply for forgiveness within 10 months after the forgiveness period ends. So, as an example of how to really extend payments into the future, if a borrower's PPP loan is dispersed on June 25th of this year, the 24-week period ends on December 10th, 2020. If the borrower doesn't submit a loan forgiveness application to the lender by October 10th, 2021, the borrower has to begin making payments on or after October 21st, 2021. So almost a full year after the loan was received would payments start in that situation.
Mark, if I could just jump in for a minute, that actual example is built into the Treasury and SBA guidance that was released late yesterday that Mark had mentioned earlier. So they're actually acknowledging that there are opportunities here to game the system a little bit in terms of really extending out when you need to make a decision as far as applying for forgiveness or deciding, hey, I'm not going to apply for forgiveness and I'm just going to pay the loan off. You've got the ability to buy yourself over a year of time before you have to start making payments. And as Mark is going to mention, on the newer loans, the loans that are dispersed after June 5th, it's going to be a 5-year term instead of a 2-year term. So you really have the ability to manage your payments if you choose to go that route.
Those are all great points, Mark. And as Mark said, this is the extension of the loan maturity for new loan. This is the one provision that applies to loans that are dispersed after June 5th, the enactment of the Flexibility Act. Originally, the maturity date on PPP loans was 2 years, and that still applies for loans issued before the enactment of the Flexibility Act. But for new loans, the maturity date has been extended to 5 years. But the Flexibility Act does say that borrowers and lenders on pre-Flexibility Act PPP loans are permitted to modify the loan maturity to reflect the changes made by the Flexibility Act. We have heard mixed things about banks' thoughts on whether they would extend pre-Flexibility Act loans. Some have said they'd extend the loan, but not at the 1% maturity rate, because there is a bit of a tension between the bank wanting to get paid as quickly as on the loan from the SBA as quickly as possible, and the borrower wanting to manage cash flow by extending the loan maturity to 5 years. So we'll see how that plays out. Federal payroll tax relief, the Flexibility Act removes the provision in the CARES Act that prevented employers who receive forgiveness of PPP loans from deferring the payment of their share of Social Security payments following the date of forgiveness. And the Flexibility Act now provides essentially that payroll tax deferral is open to all borrowers. Next slide. So now Mark and I are going to get into the nuts and bolts of the application. But before we start, I did want to mention that there is a new PPP loan application that was recently issued. The forgiveness application has not changed yet. We do expect changes to be made to it to conform to the Flexibility Act and guidance that was issued subsequent to the issuance of the forgiveness application. But when that is going to come out, we don't know yet. But we're told by the Treasury and the SBA that it's a high priority for them. Next slide. So the forgiveness application was issued on May 15th. Depending on your lender, you may have to submit it in paper form. You may be able to submit it in electronic form. And it consists of 4 parts: a forgiveness calculation form, a couple of schedules, and a demographic information form. And it's the calculation and the Schedule A that have to be submitted to the lender. Next slide. So before Mark actually goes into the application, I just wanted to tell you a couple things that are new in the application relative to guidance that was issued on forgiveness prior to the application. Under the application, accrued interest is not forgivable. That's a deviation from SBA interim final rule, which said accrued interest was forgivable. The application provides for an alternate covered pay period, and that applies to payroll only. And essentially borrowers with biweekly payroll, which is 26 pay periods, can elect to calculate their payroll costs using the 8-week period that begins on the first day of the payroll period. We don't know yet whether that alternative covered period is going to be extended to apply to the 24-week covered period. The application requires borrowers to indicate whether they received a loan in excess of $2 million. And the application expands on the FAQ 40 exemption from loan forgiveness reduction based on reduced headcounts. And it states that in addition to wanting to rehire somebody who refuses to come back, not dinging you for reductions in headcounts, the application states that some other events don't cause a reduction in full-time employees during the forgiveness period, and that's if the employee is fired for cause, voluntarily resigns, or requests and receives a reduction in hours. Two other things, and I'll finish up. Non-cash compensation to owners is excluded, so owner-related healthcare, retirement benefits, and employer paid state and local unemployment taxes aren't included in the definition of payroll costs for these taxpayers. It provides a method for calculating full-time employees, which Mark will get into later, and it changes the language cost incurred and paid language in the CARES Act to costs incurred or paid. And that's important because you could theoretically accumulate payroll costs and pay them during the covered period. So they're included in the forgiveness amount. For example, paying your March wages after you receive the PPP funds in April. But we don't know how far back the borrower can go and do that. On the same line of thinking, an employer contributions to retirement and health plans that are incurred or paid during the covered period would likely count towards the determination of payroll costs and the forgiveness amount, maybe even regardless of the year that those contributions are attributed to. So, for example, an employee that contributes $200,000 a year to a defined benefit plan that hasn't been funded for 2019 or 2020 could theoretically contribute as much as $400,000 to the plan over the covered forgiveness period. And that $400,000 would count towards payroll costs. And you might want to, employers might do that if they don't have other costs that are sufficient for full forgiveness. And lastly, eligible non-payroll costs must be paid during the forgiveness period or incurred during the forgiveness period and paid on or before the next regular billing date, even if that billing date is after the covered forgiveness period. So potentially mortgage interest and rent in arrears could be paid during the covered forgiveness period and count towards the 40%. With that, I'm going to hand it over to Mark Tarallo to walk you through the actual forgiveness application. Take it away, Mark. I think you're on mute, Mark.
I was. Sorry about that. Thank you. Just to let everybody know, we don't always have a 2-mark rule for our presentations. We try to impose a 2-mark requirement, but we don't always satisfy it. So thank you for bearing with us, and hopefully it hasn't been too confusing as to which one of us is talking. I want to pick up, obviously, with the next slide, please. The one more. Thank you. I want to pick up with the application itself, and hopefully everybody received a PDF or a link to the application. And if you have a moment, to either open that up or print it out now, because I'd like to refer to some of the sections in that. And while I'm doing that, I want to try to address a particular issue that's come up a couple in questions already, and will come up when I walk through the application. When the Flexibility Act was approved last week and entered or enacted into law, they didn't provide a new application. So we are expecting at some point that a new application is going to be put out and will be applicable for anybody who still has not yet submitted their applications. There may be some people who submit the applications prior to that, and for them it won't matter. But I want to cover the time period very quickly. The original time period was 8 weeks. It was a flat 8 weeks from the day you got your proceeds. A lot of borrowers had issues with that and complained, and in response, the SBA adjusted that. The SBA and the Treasury adjusted that, and they provided for what was called an alternative covered period. And so you could sync up your disbursements with your payroll, and you could actually start your covered period on your next applicable payroll date. That's the alternative covered period. Still an 8-week period, but now it starts on your first payroll after you receive the loan versus the date you receive the loan. So again, covered period, 8 weeks from the day you get your loan. Alternative covered period, 8 weeks from the first payroll date after you get your loan. Under the Flexibility Act, they added this 24-week window. And what they've provided for, as Mark commented, it is a little bit inflexible. They didn't provide for whether or not you could sync it up with your payroll or not, but I think their thinking is with 24 weeks, they probably don't need to do that because you can manage it with your payroll. So you've really got 3 choices. If you've already, or if you received your loan prior to June 5th, you've got 3 choices. You can use the original 8-week window, you could use the 24-week window, or you could use the alternative covered period, which is 8 weeks from your first payroll after you received your funds. If you're going to use an 8-week window, whether it's the alternative, whether it's the covered period 8 weeks from the date you got your loan, or the alternative covered period 8 weeks from your first payroll, you have to use the payroll money within those 8 weeks. You can't fill out an application for those 8 weeks saying, well, I'm going to use the money during the 24-week period. If you're not going to use the money, if it's going to take you till some period of time within that 24 weeks, then you have to use the 24-week period for payroll. You can't say, well, I want to use the 8 weeks, but I will use the money going forward. That they don't allow you to do. You have to pick one or the other. If you've depleted your PPP funds within the 24 weeks, as Mark pointed out, they haven't given guidance as to whether or not a 24-week, or whether or not there's a period within the 24 weeks that you could use as a covered period. I would suggest working with your bank and talk to your bank and see how they want to handle it. The forgiveness is going to be handled at the bank level, not the SBA level. It's your bank that's going to handle it. So if you've depleted, let's say you're 15 weeks in, right? You get your money on May 1st, and by the end of July, you've used all the funds and you've used it all on payroll, and it's all going to be forgivable. I would suggest working with your bank to see how they want to handle it. My guess is, in the absence of any further guidance, and I expect we will get further guidance on this point, but even if we don't get further guidance, my guess is your bank is going to want you to submit it anyway, because again, they're going to be the ones signing off on forgiveness, and they want to get these loans off their books as soon as possible. So with that, you have a practical concern, right? Everybody looks at this and says, hey, great, 24 weeks. But you have to think through some of the other issues before you decide, well, I'll just go with the 24-week period as the covered period, as opposed to one of the 8-week windows. You need to make sure that during that 24-week period, you're not going to have further layoffs, or you're not going to be reducing salaries during that period, because those are the 2 things that will hurt your forgiveness. So you've got a little bit of time, and you need to put in a little bit of thought. Do you want to go with the 8 weeks, even if you haven't spent all the money, or do you want to stretch it to the 24 weeks if you think you can maintain salary and maintain headcount, as we'll talk about going forward? Those are really the only 2 things that are going to hurt your forgiveness levels. So anyway, with that, let me jump into the documentation. And I think the way to approach the forgiveness application process, and again, we're almost certainly going to see a revised application, but a lot of this is still going to remain applicable. The way to approach the forgiveness application would be the way that you approach your financial reporting or your taxes. Not the way I do it, which is to put everything in a plastic bag and drop it off at my accountant's 48 hours before they're due, but the way normal people do it. Gather up all the information that you're going to need. Get everything together in place before you get started, because ultimately you're going to have to submit a significant amount of this with the application anyway. So why not just gather it all up and make it easier on yourself before you start the application? So on this page, this slide covers a number of the things that you're going to need to document your payroll expenses: bank accounts, tax forms, health insurance receipt, payments for health, receipts for payments to health insurance plans, receipts for payments to retirement plans. And look, every service provider out there is aware of what the requirements are going to be for their customers to submit these applications. So they know that you're going to be asking for these. So don't hesitate to ask, but at the same time, don't wait till the last minute either. If you know you're going to use just the 8-week period, put your providers on notice, let them know you're going to be asking for that. The payroll tax filings, there's a little bit of an issue there. If you end up going into July, right? If your period runs, your 8-week period runs into July, you may need to wait until the end of September to get your Q3 payroll tax deposit information. So that may delay a little bit the application process and the processing of your forgiveness. But generally, these are all things that you're going to need to provide with the forgiveness application. So you want to gather them up. Again, keep them organized. Don't put them in a plastic bag like I do. Next slide, please. This is some of the information that the SBA has provided that you're going to need to gather up to document your headcount levels, right? Because again, there's only two ways. I'm going to keep hammering this point. Assuming you use all the money for appropriate expenses and assuming you satisfy the 60-40 split. And again, we know now that the 60-40 split isn't going to be a cliff. It's going to be proportionate. And what that means is not more than 40% of your forgivable costs can be non-payroll costs. So assuming that you meet the 60% and assuming you've used everything on forgivable expenses, the only way your forgiveness is going to get cut is if you reduce headcount or you reduce salaries. And that's why these two buckets here are the two biggest buckets of information that you're going to need to provide to your lender in order to support your forgiveness application: the salary numbers and the headcount numbers. This is some of the information here that you're going to need to gather in order to document what your headcount looked like during the covered period. Next slide, please. And then this is some of the information. And again, this is all required. This is not optional. We're going to talk at the end about some stuff that you're going to need to retain for a 6-year period, but don't have to provide. Those two prior slides plus this slide here, that's all stuff that you're going to need to provide with your application in order to have your lender process it for forgiveness. So for the non-payroll expenses, you're going to need documents from your lender. You're going to need an amortization schedule and proof of payment. Lease payments, you're going to need a copy of your lease. And bear in mind, and we're going to talk about this a little bit, this may include personal property leases as well. So things like hardware leases, copier leases, automobile leases, things like that. You need to get copies of those as well. It's interesting when the initial guidance, way back in April, when the initial guidance for the PPP program was put out, they mentioned that the obligations for things like mortgage interest and rental payments would only be forgivable if they were related to obligations that were in place as of February 2020. They didn't say anything about providing actual copies of those documents. So, this has come out through the forgiveness application process. So now people are on notice. They have to provide copies of these documents. So again, if you've got related party leases, for example, you have an operating business and you own the real estate, you need to have something written in place as of February 2020 that you're going to need to provide with your application in order to get your forgiveness application processed. The utility payments, that should hopefully be reasonably easy. Statements from your utility providers should be adequate for your lender. I can't imagine they'd ask for anything like a service contract or anything like that. So ideally, they're going to take the easy route on those. Next slide, please. Okay. I'm just going to take a pause here for a minute. Give everybody a chance to take a look at the actual forgiveness application itself, and in particular, page 9 of the application, which is the Schedule A worksheet. This is really the heart of the forgiveness application, because again, the only two ways that you're going to decrease the amount of forgiveness is if you've cut salary or if you've cut headcount. And so these are the tables where you're going to calculate both the salary and the headcount numbers for the employees that you have. They've specified the order in which the forgiveness reductions are going to be applied. The way it's going to work is you're going to apply the pay level reduction before the headcount reduction. So you're going to compare both. You're going to apply both. Sorry. You're going to need to apply both, and there are going to be recovery opportunities on both as well in order to get back to a full forgiveness level. So next slide, please. So this is table 1. And there are, as I mentioned, there are 2 tables on the worksheet. This is the worksheet to Schedule A. And generally the way it works is you complete the worksheet, then you port a lot of that information over to Schedule A, and then you port the information from Schedule A over to the actual forgiveness application itself. There are 2 tables in the worksheet. Table 1 is for employees that are making less than or equal to $100,000 and that are living in the United States. I don't know how much of an issue that's going to be for employers, but you only apply the analysis here for employees that are resident in the United States. The principal place of residence is in the United States. So table 1 is for people making less than or equal to $100,000. And again, that's important because this is the only place on the salary side that you're going to lose forgiveness. If you reduce the salary of anybody making $100,000 or less by more than 25%, that's going to cut into your forgiveness number. Again, only people making $100,000 or less. If you reduce the salary by 25% or more, then you are going to cut into your forgiveness. So if you have an employee who is making $50,000, if you reduce their salary by on an annualized basis by an amount equal to or greater than $12,500, the amount over that is going to cut into your forgiveness. And if you go to the next slide, please.
Hey, Mark, this is Mark Farner. I just wanted to add one point about Table 1. Can we just go back to Table 1 for a second? I just wanted to point out that the language of Table 1 says that the reduction only applies to employees who make, less than or equal to $100,000 for all payroll periods in 2019. And some practitioners have taken and borrowers have taken the position that if there is a single pay period where on an annualized basis the person would make more than $100,000, then that person is not a Table 1 employee. So for example, if an employee makes a salary of $80,000 in 2019, but receives a $5,000 bonus during 1 2-week period, that employee's annualized salary for that 1 2-week period is more than $100,000, even though the employee only made 85 grand for the year. And some people have taken the position that employee is no longer a Table 1 employee because of that 1 2-week period where they got the bonus that put them over the $100,000. And that may or may not be corrected on or made more clear on the revised application.
That's a good point, Mark. And why is that important? That's important because if they're not a Table 1 employee, they're a Table 2 employee. Table 2 employees are the ones who make more than $100,000 on an annualized basis, and reductions in comp to those employees do not impact your forgiveness number. Next slide, please. So the next couple of slides are directly from the instructions themselves, and it's essentially the methodology for calculating whether or not you've reduced the salary of a Table 1 employee by more than 25%. And it's a fairly simple mathematical exercise. You decide what you're going to use, whether it's the 8-week or 24-week covered period, or the alternative covered period, the 8 weeks that start on the next payroll. You look at their average annual salary during that period. You look at their average annual salary between the period of January 1st and March 31st, and you compare the numbers. And if the reduction is more than 25%, then you need to drop that number into the Schedule A worksheet, and that number on that final box is going to be a number that gets reduced, that reduces your forgiveness unless you're able to apply some of the catch-up provisions, some of the makeup provisions there. Next slide, please. And this is the guidance on the on one of the safe harbors for the salary wage reduction calculation. If you can satisfy this, right? You look at the annual salary of the hourly wage as of February 15th, and then the average between February 15th and April 26th. And if you are, if you satisfy that, then you're not going to have a number that has to be entered into the salary hourly wage reduction box. There is one thing I want to point out, and there's a little bit of a difference between how we treat salaried employees and how we treat hourly employees. If you have a salaried employee who is making, again, let's use $50,000 a year last year, and then you've had to cut their compensation this year, that will constitute a wage reduction. Whether or not it's over 25%, you have to go through these steps to determine. But if you have an hourly employee whose hourly rate, let's call it $20 an hour, and they typically work 25 hours a week, but during the covered period, the number of hours are cut down, you don't have a wage reduction for that person. You might have an adjustment in the number of full-time employees, which we'll get to in a moment. But if an hourly employee is making less simply because they are working fewer hours, as long as their hourly rate stays the same, that is not considered a wage reduction. Again, it may be considered an adjustment in the number of full-time employees, and we'll get to that in just a second, but it is not considered a wage reduction. Next slide, please. Actually, if you could skip ahead one more also. Okay. And these are again just the steps to make sure that you've satisfied the analysis for the wage reduction, if there is any. If you haven't reduced anybody's wages, then you're not going to suffer a loss of forgiveness from with your application. You're not going to have any loss of forgiveness. If you've reduced wages of somebody making over 100,000, you're not going to have a negative impact. It's only for the employees making less than 100,000 or less, and if you reduce them by more than 25%, it's the amount over that is going to create a deduction or a reduction in your forgiveness amount. Let's see, go to the next slide, please. And this is table 2. This is for employees making more than 100,000. As you'll see on this table, it doesn't have the boxes for the salary reduction. Again, because salary reductions for an employee making over $100,000 aren't going to impact your forgiveness amount. Next slide, please. And a couple of points about the salary when you're going through the salary process, right? The $100,000 number is kind of there for whatever reason. That's the number that they used as the peg number, right? So for any employee, your number in the table shouldn't exceed that 15,385 number. That's if you're using either of the 8-week covered periods. If you're using either the 8-week covered period or the 8-week alternative covered period, you shouldn't have a number larger than 15,385 in table 1 or table 2 for any individual employee, because that's the cap. Now that's going to change when they issue the new forgiveness application. That may change to account for the 24-week period. But for right now, that's really where that's the cap based on $100,000 annual salary. That applies to owners as well. I think we've talked about that in other places, but that's the maximum amount that can be forgiven for owner compensation as well. you should only be counting payroll costs once. You can't double dip. So if something was paid and incurred during the period, you can't double dip. It can only be counted once. We've got guidance now that you can include bonus pay, hazard pay, frontline pay. I mean, obviously, you know, if the employment lawyers were on the call, they'd be saying stay away from the term hazard pay because it implies that you're putting people in a dangerous situation. You just call them bonuses. But again, only up to the $100,000 limit. And if you're going over that number, if your bonuses are taking people over 100,000, the amounts over that are not going to be forgivable. Same thing with payments to furloughed employees. If you've let somebody go, but you've committed to paying them for a couple of weeks or a month, those payments are includable as well, but it's subject to the $100,000 limit, the $100,000 annualized limit. And last, as we've talked about a number of times, payments for healthcare, for retirement, mandatory payments, mandatory employer contributions, things like that are all forgivable, but those are not prorated in with the $100,000. A lot of people have asked that question, like, okay, I think my employee makes $80,000. Do I then have to add in an amount for their pro rata portion of healthcare costs? And the answer is no. The healthcare costs sort of stand on their own. They're not divided amongst the employees that you have. So those are forgivable. Those are really a nice opportunity to use a fair amount of the PPP money and not have to worry about salary deductions or reductions in headcount. Next slide, please. So once you've completed the Schedule A worksheet, you're going to move to Schedule A. And if you take a moment and turn to Schedule A in the application itself, Schedule A is on page 6. And Schedule A is actually pretty straightforward. Once you've been able to do all the calculations for each employee, again, to determine if your headcount has stayed the same, if your salaries have not been reduced by more than 25% for anybody making under 100,000, everything sort of ports over to this Schedule A, and you'll see there are lines for health insurance, retirement, state and local taxes that are applicable to the employee compensation that you've been paying, owner compensation, those sorts of things. Those are, as you'll note, those are not subject to the qualifications like you see on the worksheet. So to the extent you're paying $25,000 towards health insurance premiums, that $25,000, when you get over to the actual application, just all gets added in. So again, the health insurance and the mandatory or the retirement contributions are a very good opportunity to use the PPP funds for something that is going to be fully forgivable. Next slide, please. This is I wanted to address real quickly the FTE issue. One of the ways in which you can negatively impact your forgiveness amount is if you have reduced headcount. But there is a little bit of flexibility here. They've actually given a couple of alternative ways to calculate headcount. if you could, next slide, please. Actually, go one more, please. So there's a couple of different ways that you can calculate headcount. Headcount is based on a 40-hour week. So anybody who works 40 hours or more counts as one employee, right? If you've got somebody who works 45 hours a week, they're still going to count as one employee. Unfortunately, it'd be nice if we could, add the overage, but you can't. So anybody who's working 40 hours a week or more is counted as a full-time employee. It's the people who are working under 40 hours where there is a little bit of flexibility. There's two ways that you can calculate how full-time employee numbers for people who are not working 40 hours. One is a straight percentage, right? So you take the 40 hours and divide by the number of hours a week they actually work. So for an employee who works 20 hours, they count as 0.5. For an employee who works 28 hours, they count as 0.7. But they've offered an alternative way to do the head count, and that's the simplified method. And that is anybody who works less than 40 hours counts as 0.5. Why is that helpful? That's helpful because if you had people who in your pre-covered period were working 28 or 30 hours a week, instead of counting 0.7 or 0.8 of a full-time employee, you can round it down to 0.5. Now you have to be consistent. You have to use this method for all employees, and you have to use this method for all the periods. You can't use one method for one period and one method for the other period. You have to be consistent. But it does give you the opportunity to basically use whichever of these methods. You want to use whichever of these methods is going to give you the lowest head count for your base number, right? So if you've got a bunch of employees who work less than 20 hours, you probably want to use the standard method and compare it against 40 hours and take that percentage. That's going to reduce the number of full-time employees for your base period. If you've got a number of employees who work 20 hours or more, you want to use the simplified method and round down for your base period, because that's going to give you the lower number of full-time employees. So again, you want to run it both ways and pick the option that gives you the lowest number for your base period, because ultimately you may actually have a reduction in headcount without actually getting dinged for this. If you've got a number of employees that are working more than the 20 hours and you're rounding down. So that's important. Before you make a decision, you should run it both ways and see which one gives you the lowest number for your base period. Next slide, please. If you could skip ahead one more slide. These are and if you do have a reduction in, I apologize, I'm going to skip ahead given the time. If you do have a reduction in the head count, there are some new methods. Mark mentioned these earlier. There are some new methods that you can use to bring your head count back up. Now you have until December 31st to restore both headcount and compensation. Again, I think we're going to get more guidance on this, but the way it reads now, it's just simply if you restore the headcount before the end of your covered period, whether it's the 8 weeks or the 24 weeks, if you restore the headcount and you restore the compensation, then you've satisfied the safe harbor. And again, there are people out there who are taking the view that if you do this one day before the end of your covered period, you've satisfied the requirement. It's an aggressive view, but they haven't put out anything yet that is contra to that. So it's just something to bear in mind. Next slide, please. This is, once you have the worksheet and Schedule A done, you can start dropping in the numbers on the worksheet, on the application itself. Again, the application is actually on page 3 of the materials that we had sent. And it's very straightforward at this point because everything else is simply being dropped in from the other worksheets. You may end up with a number, a potential forgiveness number that is higher than your loan amount. That's why one of the items on the worksheet is the actual loan amount itself on line 9. And once you've dropped in all the numbers on 8, 9, and 10, you take the lowest of those numbers. And hopefully you've gotten to a number that's actually greater than your loan amount, because that means your loan will be 100% forgiven. Next slide, please. Just very quickly, these are some of the things that can be included as non-payroll expenses. You can't prepay your mortgage interest, but as Mark said, you might be able to make catch-up payments. So if you were in arrears, you've fallen behind a little bit. If you pay those during the covered period, those should be forgivable. Rental expenses, they haven't been clear on excluding personal property. So people are taking the position that personal property rental is going to be forgivable. Copiers, computers, equipment, forklifts, all those types of leases, those should be forgivable. They have not said that related party costs are excluded. So again, if you've got an operating business and you own real estate and you're making regular monthly payments pursuant to a written lease that was in place as of February of 2020, you should be able to get forgiveness on those. And utility costs, some of those are pretty self-explanatory: electricity, water, sewer, internet. They include transportation in there. We're probably going to get more guidance on transportation. Does that include auto leases, mileage, fuel, maintenance? Plain language would be yes, it does, but we're waiting for further guidance on that, and I think that should be hopefully forthcoming soon. Next slide, please. Actually, why don't you skip to 34? This is a list again of just some of the documentation you don't need to provide, but you do need to retain. I would certainly recommend, if you've got a loan over $2 million, there's a specific box on the forgiveness application for loans over $2 million that you have to check. I'm assuming anybody who checks that box, that's going to go into the higher likelihood of audit pile. But these are things that you should maintain for 6 years in case you do get audited. But again, that you're not required to submit with the application, unlike the other materials, which you're absolutely required to submit with your application. Next slide, please. And at this point, I know we're running a little bit over, but I'm going to turn it back to Mark just for a quick update on some of the more recent interim rules we've seen from the SBA.
Thanks, Mark. Just before I go over those interim rules, I just want to stress to people that you need to start preparing for the audit process now. Organize the records, the receipts, the documents on an ongoing basis. You want to create a record of how the PPP loan proceeds were used. We suggest actually conducting an internal audit to assure that there are no gaps in the PPP loan application, and just document, everything that has gone on with the PPP funds. You also want to just review and check the accuracy of your good faith certifications that you made or that you made as a borrower on the application. as part of that audit, internal audit process. Moving back to the SBA interim rules, just very quickly, next slide, please. So these rules that came out June 1st track a lot of the previously issued guidance and forgiveness application. One additional piece of, one additional requirement to avoid a reduction in loan forgiveness is that when an employee declines an offer to be reemployed at the same salary and hourly hours, the employer has to show that it contacted the state unemployment agency and made that offer within 30 days of the rejection in order to qualify under that exemption. Mark mentioned the other points about furloughed employees, hazard pay and bonuses being eligible. Mark mentioned that borrowers won't be doubly penalized for both wage reductions and full-time employee reductions, as long as the reduction in wages is commensurate with the reduction in hours, but the same hourly wage is still being paid to that employee. Next slide. The guidance says that the SBA can audit any loan it chooses, can audit the eligibility for the loan, the amounts and how the loan was used, the forgiveness amount. And there was a lot of confusion about previous guidance that said borrowers that didn't receive loans of $2 million or more wouldn't be audited on a certification that they're required to make, saying there was an economic need for the loan, but that safe harbor only applies to that specific certification that there was an economic need. The SBA can audit, for other reasons other than that certification if it chooses to do so. The lender has 60 days from the receipt of the complete forgiveness application to issue a decision to the SBA. And if the lender decides that the borrower is not entitled to forgiveness in any amount, the borrower actually has 30 days of receiving that notice from the lender that is not entitled to forgiveness to request that the SBA review the lender's decision. The borrower can also appeal an SBA determination that the borrower is ineligible for the PPP loan, ineligible for the loan amount that it got, or ineligible for the forgiveness amount claimed by the borrower. And with that, the presentation is done. We thank everybody who decided to participate in the presentation. Thank you very much, for your time. You could have been anywhere, and thank you for spending it with us. And as I said at the beginning of this program is being recorded, and the recording and slides for the presentation will be available to everybody. And you can always email Mark Tarallo or me, Mark Feiner, with any questions that you may have. We apologize for not being able to get to the questions that were submitted in the chat room.
Although, Mark, I was, and I want to thank everybody as well. And I just want to say, look, I know, what Mark said at the beginning is probably accurate. I mean, we're expecting a completely revised or substantially revised loan forgiveness application at some point. In the Treasury Secretary's comments earlier this week, he noted that a new application and further guidance would be forthcoming, and we will do our best to keep everybody apprised when that happens and when those changes come out, and whether or not how they're going to impact everybody that's looking for loan forgiveness. We don't, at this point, we don't expect that the provisions around retaining headcount and retaining salaries are going to change much, especially given the new safe harbors that they've built in, but we'll see. I do understand we've got quite a few questions. We could probably, I'm able, I don't know if Mark is able, I'm able to stay on for a few more minutes to answer some questions. Mark, I don't know if you've got available.
I'd be happy to
Yeah.
go through some of,
So maybe, you know, as a reward for those of you that have hung in there this long.
so I'll just read the questions that were in the chat room and respond. And Mark, you can add or tell me that you disagree. Will the alternative covered payroll period apply to salaries paid monthly? It only applies to salaries paid on a biweekly period, or more than a quicker biweekly period.
Biweekly or more frequently. So I don't think you could apply the alternative covered period. But I do think with some of the new language, the incurred and paid, there may be some ability there to offset payroll that's paid after that date.
The next question is, what if the PPP funds are fully depleted before the 24 weeks? Do we submit the forgiveness application then or after the 24 weeks?
That's the question that I was trying to answer on the fly, and I apologize if I didn't do a good job. I think that's one where you want to reach out to your lender. The new rules don't provide anything other than the 8-week period or the 24-week period. They don't say, well, there's a 17-week or a 12-week covered period. I think that's one where you want to reach out to your lender, see if your lender will take the forgiveness application, and if they will, work with them to get it done. If they will, you want to get it done right away, because as I mentioned before, if you wait till the end of the 24 weeks, you still got to deal with those issues of maintaining your headcount and maintaining your salaries. And if you can get the forgiveness application in and get it processed, then that takes that off your plate. So with respect to that, we can't give you any chapter and verse because there isn't any out there right now, but I would say reach out to your lender and see if they can work with you on that, because I guarantee you they want to get that loan off their books just as much as you want to get that loan off your books.
Other questions that were emailed in before the webinar: does a sole practitioner include the owner of a single member LLC? The answer to that question is yes. Can the owner of a single member LLC include his own compensation up to the $15,000 limit? It's a little bit more than the 15,000. I don't remember the 15,000 and change off the top of my head, but yes. The answer to that is yes. We've addressed some of the other questions. Can 100% of the money be used for payroll and the owner's compensation? We've actually gotten that question a few times, and the answer is really the purpose of the CARES Act was to keep people on the payroll. So while you have to use or your loan is reduced if you don't use at least 60% for payroll, you can use 100% of the PPP loan for payroll if you choose.
Right. The 60-40 split isn't mandatory. I mean, if you look at what the PPP is in reality, it's a government program that they're using the employers to administer, right? If you think about it that way, then some of the guidance really makes a lot more sense. They want you to keep your people employed. They want you to keep your people employed at the same rate of pay. I don't know why they came up with $100,000 as some magic number where people making over that amount, should be subject to pay cuts, but that's what they did. But it's really a program that is intended to focus on the employment side. So, and I know we've gotten a couple of other questions on this. If you use 100% on payroll and payroll related costs like health insurance and retirement, then you're going to get 100%, assuming you're within all the other limits, you're going to get 100% forgiven. The thing about the owners is the owner's compensation, the forgiveness piece there is limited to that 15,384 number. So if you use 70,000 of it to pay owner's compensation, you're only going to get forgiveness up to that number. So that's the one thing to bear in mind.
I believe we've actually answered the other questions in the presentation, not specific to the person that wrote in, but I think we've covered the questions that they have asked.
Well, we've got a couple more in the chat box. I'm going to just try to go through those quickly. Lease
Okay.
ends on 7/31 and it's being renewed 8/1. Yes, that should be covered. It's the same if it's the same lease, same space, but you got to make sure that the underlying lease, the lease that is ending on 7/31, make sure you've got documentation for that. Make sure you have an existing lease and a written renewal, so that you can show that the expenses were being used for an obligation that was in place as of February of 2020. Let's see. Do payroll expenses like SEP and 401k count in the payroll costs for self-employed people? I don't believe that they do. I don't believe that those can be forgiven. If you want to, I think everybody's got my information and Mark's information. If you want to send us an email directly, we can follow up with you on that. But I believe those are excluded. What's that?
I believe it's as well. All the healthcare, retirement expenses relative to a self-employed person are not includable in payroll. That person is capped at the $15,000 number.
Yep.
Period.
The $100,000 question. So if someone only makes 50K, but they get a 10K bonus, say, they may fall into table 2. That's correct. But again, as Mark pointed out, that's an aggressive view that some practitioners are taking. Again, bear in mind, you want to move as many people as you can into table 2 because their salary reductions aren't going to impact you, but the government obviously has an interest in lower paid employees being kept on at the same rate. So it's an aggressive approach, but there are people who are suggesting that. So yeah, so you get somebody who's got a 50K base, but they get a 10K bonus in a given month. That's going to bump their average salary up over 100,000. You could take that aggressive posture, but you know, it's ultimately it's going to be up to the bank and then the SBA if you get audited. Let's see, if an owner is paid $6,000 a week during this PPP period, is this amount considered in the forgiveness amount? First, I would ask if the owner is being paid $6,000 a week, are you hiring? if you're taking out $6,000 a week, and the answer is only up to that $15,000 limit, only up to that $15,384 limit. So the first couple of weeks would be included, but once you hit that 15,000 limit, anything above that number, right? Because that's it on the annualized basis of $100,000. Anything above that number is not going to get is not going to be eligible for forgiveness. It seems really unfair that owners are not eligible to be forgiven for health insurance or retirement. I don't know. And Mark, I don't know if you want to weigh in here. If you want to take the next one, which is the payroll taxes one.
Sure.
Again, you have to look at the goal of the Paycheck Protection Program was to keep the lower. Look, let's face it, they were targeting lower income employees that they wanted to keep employed, and so I don't know that will necessarily change with the new legislation. That's the one thing, they haven't done much so far on the owner's side, so I don't know. I wouldn't count on it, I guess, unfortunately. Look, Mark and I are in the same boat, right? We're technically owners because we're partners in a law firm, and it's unfortunate, but I think that may be what we're stuck with.
All right, so the next one, employer payroll taxes, are they forgivable? The answer is the payroll taxes, I don't believe the payroll taxes are forgivable. They are just deferrable, even if an employer receives forgiveness. As a matter of fact, I do believe it's only the employee side, that's forgivable. But if you email me separately, I'll get back to you on that question. Unless, Mark, you know the answer off the top of your head.
I don't.
Okay. The next question is, if we don't contribute to health insurance in general, employee pays 100%. Can we choose to cover some percentage of that within the covered period to help the employees and get them forgiven? The way that it is currently, the guidance is currently written, an employer could make contributions on behalf of the employee during the covered period to.
Yeah, I would agree with that. Or alternatively, if you've got an employee who's making less than $100,000, you could give them a bonus of, call it a health insurance coverage bonus of $10,000 or $15,000 that they could use to pay the premium as well. And that would, as long as you're under the 100,000, that also would be forgiven.
Okay, the next one is, if an employee whose salary was over 100,000 in 2019 was lowered to 100,000 in May, would this benefit in the loan forgiveness? Mark, I'm not quite sure what the person who wrote in is trying to ask. Maybe you have
Yeah, if they were over, I think the answer is no, strictly because of the way the tables are set up. I think you'd have to include them in table 2. And if they're included in table 2 because they were making over $100,000 in 2019, reducing their salary and then paying some of it isn't going to impact the forgiveness.
The next question is, can you reapply once you receive but have not used the PPP funds if your needs change? I think the answer to that is no. I think that it's clear that a person is only allowed to get, or borrower is only allowed to get one PPP loan. If the loan was if you didn't actually accept the proceeds, I think you might have a different answer. But I think once you get the PPP loan, you are stuck with that loan.
Yeah, the legislation says, so that actually deals with both of them. That one and the next one, which was, can you request increase or additional amount of your loan? The answer is probably not. For both of those questions, the original legislation said you can only get one PPP loan. Now, it seems like it was a year ago, right? But it was only last month. If everybody remembers, they created that safe harbor period where if you got the proceeds and then had second thoughts about it, you could return them, no questions asked. I've had a couple of people say to me, well, we did that. We sent the money back and now we're having second thoughts about that. Can we reapply? And we've reached out to a couple of banks and have not gotten an answer back on that. So but if you've received the money, or if you want to try to get more money, the answer is no, you can't. Right now, anyway, you can't. Again, that may change given that there's still $130 billion available in the program, but as of right now, no.
All right. You know what, Mark? I actually have to go.
Okay. I'll try to finish up these last couple, and I think this will be it, the one ending with electric for utilities, but I'll try to finish up these last couple.
Okay. Well, I want to thank everybody again for participating, and everybody stay safe. Take care.
Yep. 401k contribution must be made prior to sending in the forgiveness application. The answer is yes, because you're going to need to include with your forgiveness application some documentation from your 401k provider as to what's been contributed to the plan during that period. So you do want to get something back from them. Obviously, you can start on the application, but you probably want to wait until you have some documentation back from them before submitting. Expenses related to the 401k plan deductible, costs for actuaries, etc., like maintenance costs and things like that of the plan. I don't know the answer to that. Again, if you guys want to reach out to me and Mark directly, we'll see if we can come up with a quick answer for you, but I don't I haven't seen any guidance on that as to whether or not those types of costs would be deductible. What if the owner didn't pay themselves in February 2020? Again, it depends on the compensation level. The owner's comp is forgivable, but only up to that $15,000 amount. So even if the owner didn't pay themselves during that period, that's not going to say lower their annual comp. Whatever they pay themselves during the covered period will be forgivable up to that $15K. Do you have to pay taxes on the PPP loan amount itself, or just have to pay salary-related taxes and fees? You don't pay taxes on the PPP loan amount, and Mark Feiner actually would have, this is right up his alley as a tax lawyer. But you don't pay taxes on the PPP loan amount itself, and they've issued guidance that says even though forgiveness of debt is usually taxable, it's not going to be here. So if you owe somebody 200 grand and you agree that you're only going to pay back 100 grand, and like the bank or something, and they agree, and you do some sort of settlement agreement, that forgiven 100 grand of debt is usually taxable income. It's not going to be here. So even if you've got a $300,000 loan, you get full forgiveness, that amount is not going to be taxable as income. However, you are not going to be able to, at this point anyway, you're not going to be able to take as a deduction any of the expenses paid using the PPP loan proceeds. So normally, right, you'd get a business deduction for your employee costs, salary costs, benefit costs, all that stuff. If you're using the PPP proceeds for that, you're not going to be able to get that deduction. So no double dip. It's not going to be taxable as income if it's forgiven, but if it's forgiven, you can't take the deduction. Now, if you decide, hey, I'm not going to apply for forgiveness, or I don't, I don't meet the requirements for forgiveness, the portions paid with the non-forgivable amounts will still be deductible on your taxes next year. And then last question, if we included electric utilities in our original application, but now find out internet phone, yes, when you should include all those amounts, electric, internet, phone. So you can deduct, or you can request forgiveness for amounts paid for like internet access and things like that, cell phone bills. You can't deduct, like, for example, if you're paying for software as a service, you can't pay for that and then request forgiveness for that. It's just the actual utilities themselves, the internet service. But you should include all of those on your forgiveness application, and you should have documentation of the amounts that you paid during the covered period, whether it's the 8 weeks or the 24 weeks. You should have documentation of all those amounts that you paid during that covered period to back up the forgiveness request. So that's it. Thanks everybody for hanging in there. Hopefully this was helpful and informative. Again, you've got our information. Reach out if you have questions. We'll do our best to get back to you as quickly as we can. And again, we'll do our best to keep you apprised of changes that come, whether it's the forgiveness application, the forgiveness standards, because I don't think this is a finished product by any means at this point. So thank you again, and hope everyone has a nice afternoon. Take care.